Welcome everyone to RedeConnect 2022. My name is Scott Church. I'm a founding partner of Rede and very happy to be kicking off this keynote webinar, the Rede View. This is our second ever RedeConnect and we're absolutely delighted to be here with you. You know, when we first conceived of RedeConnect last year, it was very much as a substitute to the in-person conferences that were subject to COVID cancellation. But it quickly became clear that virtual events like these can be really additive to the calendar, keeping everybody in the loop without taking participants out of the flow for whole days or weeks, and I might add, without adding any transport miles to your carbon footprint. On the other hand, after last year's great success, we had a very real concern. Is this going to be that difficult second album for RedeConnect? Well, we took inspiration from some famous friends who managed to pull their greatest efforts out of the bag on the second go-around. You may have noticed some of these soundtracks while waiting for us to go live. And we're hoping that RedeConnect 2022 will be our own second triumph. We've got a really packed agenda for you over the next 3 days. We'll be streaming 6 webinars, including this one, and 121 small group virtual roundtables for LPs to meet with our exceptional roster of GP clients. We've had over 600 industry participants register for RedeConnect as a whole, and we're so glad you could join us today. For this segment, in addition to myself, you'll be hearing from my co-founding partner, Adam Turtle, my partner and head of North American coverage, Alex Bazarewski, and Gabby Joseph, our head of due diligence and client development. Over the coming 3 days, you'll be hearing from several of my other colleagues as subject experts delving into some interesting facets of our industry. Tomorrow, my colleague and partner, Magnus Goodlad, will host a fireside chat on today's secondaries opportunity with special guest Gabrielle Joseph of Goldman Sachs. Our Impact GPs showcase will be a dispatch from the front line led by our head of Impact, Jeremy Smith, and including speakers from 4 notable GPs in the space, Summa, Verdane, Vidya, and Apex. My partner, Christina Wittegren, will be moderating another GP panel to discuss the latest market developments and implications for real economy investors with representatives of Alchemy Partners, Angelus Equity, Sterling Square, and Wise Equity. And on Thursday, my colleague Mike Camacho will be leading us in a Rede Masterclass on the remarkable growth in NAV financings. Now, this is a subject that we've been getting quite a lot of questions on from LPs, so looking forward to Mike helping to demystify it for us. We'll follow that with a discussion of findings from our Rede Credit Survey and Report, just recently undertaken, and this will be elucidated by a panel of industry experts from Axia, Golding, and Pantheon. Finally, it would be remiss of us not to mention some of our own highlights here at Rede over the last year. Since we last spoke to you at RedeConnect 2021, we've had 12 final closes, which includes 1 first-time fund and 3 new platform extensions. We reached or exceeded the fund size target for all these funds, and in all but one case, we hit the hard caps. Over the year in total, we raised 21 billion euros, including 7 billion of new money. We've also advised on GP-led transactions worth over 4 billion euros, including 4 NAV financings. And we're very excited to announce the opening of 2 new offices in our network in Hong Kong and Amsterdam. Just before we dive into the presentation, I wanted to remind you that we would like to take your questions and we'll reserve some time at the end to address several. Please do send those in using the Q&A function on your Zoom. Our plan is to try to keep this whole discussion to about an hour, including 10 to 15 minutes for Q&A at the end. And now I'll pass it over to Adam to lead us into the next segment of our presentation.
Thank you very much, Scott, and welcome to everybody who is listening. So last year at RedeConnect, at our 10-year anniversary, we challenged ourselves to make some predictions about where we thought private markets would be going in the next 10 years, so by 2031. And we made 5 core predictions that are outlined on this slide. And because we love to mark our own homework, we're proud to say that thus far we feel like we did pretty well, at least in year 1, only 9 more to go. And first off, we predicted a major growth in private markets underpinned by investors changing the way they think about allocating to private markets from a model that distinguishes publics and alternatives to one that distinguishes liquids and illiquids. And 2021 was certainly the biggest fundraising year on record. And despite some of the negative clouds we're going to talk about in this presentation, we think that 2022 will also show significant growth from 2021, driven in part by the large number of GPs that are currently in the market. Secondly, we predicted a continued expansion of GP brands, fueled by the benefits of ever deepening competitive advantage, and fueled somewhat by growing GP balance sheets. And it's been interesting that this year we have certainly seen a continued expansion of the number of platform extensions in the market, a number of which we have advised upon, as well as some notable GP to GP M&A of the sort of which and the volume of which I don't think we've seen in the past. Thirdly, we predicted that the blind element of the 10-year blind pool would come under a little bit of threat as GPs chip away at this through seeking to maintain control of some of their best assets for longer by transferring them to new vehicles that they control. This has become somewhat of a snowballing trend, as you can see from this stat. And interestingly, far from being resisted by many LPs, in many cases, LPs themselves are encouraging GPs to do this and actually being counterparties and acquirers of those assets. So that is a trend that we continue to see. Fourthly, we talked about climate and how climate would be the story of the next 10 years in the way that technology was the story of the last 10 years. And there's certainly been an increased interest in impact and climate-related strategies. And we've also seen, importantly, climate-related assets both receiving premium valuations and delivering excellent performance for a number of managers. And finally, and last but not least, we predicted that with great power comes great responsibility, and as private markets continue to grow and become more important, they would come under more scrutiny from government. And we saw a clear example of this earlier this year with SEC proposals to significantly increase regulation of private equity funds. And it was interesting, I think, that perhaps SEC Chair Gary Gensler was listening to our webcast last year, when he said in his report, private fund advisors, through the funds they manage, touch so much of our economy that it's worth asking whether we can promote more efficiency, competition, and transparency in this field. I do not think we've seen the last of that as we look to the next 10 years. So it feels like, although we're only 1 year in, it feels like we're somewhat on the right track with our initial predictions. We shall see. However, in truth, these days, probably more than any, it feels like a lot can happen in a year. If you remember back to a year ago, we were all sitting around looking forward to the COVID reopening, whenever that was going to happen. And many people were predicting that we would see a roaring 20s to mirror that of the post-Spanish flu pandemic of the 1920s. Sadly, right now, some of those nostalgic predictions seem a little bit premature, and there are some more troubling portents on the horizon. So, much like this daring gentleman in this particular photograph, we thought we'd try and get up close and investigate the weather ahead. So for this year, instead of lofty long-term crystal ball gazing, we thought we'd make some short-term predictions and really get down to what we think is going to happen in the next 12 months in fundraising and with investors. Now, obviously, this carries the risk of looking stupid in the short term, as Warren outlines here. So therefore, to take you through it, I'm going to pass off to Gabby.
Thanks, Adam. It's okay. I've never minded looking stupid. Looking back, it's been a truly gilded age for those of us in the private markets. If we think about the years since the GFC, we actually need to acknowledge some of the leg ups that we've benefited from as an asset class. Realistically, we've been living in a world of almost free money, which has boosted performance of buyouts and lowered the stakes considerably when it comes to the risks of levering up businesses. And with billions of dollars injected into our economies, we've also been living through a boom in liquidity across the whole class of equities, which creates a real helping hand for private markets, with liquidity cascading down from LPs to individual portfolio assets. And that's fed into a rising tide of valuation multiples right across the board. And so in some sectors, multiple expansion has really been so pronounced that you could look clever just by buying, holding and selling quite an average business in the right sector. And then by late 2020, it became clear that even a global pandemic wasn't going to spoil our party. and we really started to feel quite invincible. You can see here how all of this is translated into fundraising momentum. So the charts, you can see it just shows private equity fundraising, so not even the rest of the private markets. And it's quite clear that private equity fundraising volumes have trebled in just a decade. So that's equivalent to a compound growth rate of 13% per annum. And actually, that little dip you can see here in 2020, I would really suggest is the exception that proves the rule. If a global pandemic and total economic shutdown is resulting in just a 7% negative growth, that really speaks to an incredibly robust asset class. All of this has actually been mirrored by our own barometer of private equity fundraising sentiment, which is the Rede Liquidity Index. It's also called the RLI. So twice a year, we ask a panel of limited partners whether they plan to increase, maintain, or decrease their commitments to new private equity funds over the coming 12 months. So we crunch the numbers into an overall score, which you can track over time. You can see it developing along the bottom of this slide here. Any score above 50 indicates LP expectations for overall market expansion. So you can see we've been experiencing really strong sentiment for growth for many years now, and just that one short blip below 50, which was during the absolute worst of the pandemic. And then after that, we had an unprecedented bounce back. So by the end of 2021, we were at a record RLI high of 70. Of course, once we've got the attention of our LPs doing our survey, we like to ask a few more questions so we can really unpack LP sentiment beyond the headline numbers. And you can see that by the end of 2021, LPs were clearly showing strong alpha-seeking, growth-oriented tendencies, with very high demand for strategies like growth equity and smaller buyouts, even venture capital. When we asked LPs about their biggest concerns at that time, the picture was even more telling, actually. So over 70% of LPs were citing coping with re-ups and GP scale-ups as their biggest headaches, and with only 6% managing poor performers in their portfolios as a big focus, it really started to feel like quite a booming market. So by the end of last year, the chatter that we hear here at Rede from LPs and GPs was kind of starting to reach fever pitch. And we've picked out a few of the things that we were hearing more and more frequently as 2021 wore on, you can see here. So to us, it was really starting to raise some questions and even some eyebrows. So LP views of what makes good performance had shifted completely. And we kept hearing this mantra, 4x is the new 3x. But then when you think about it, there's a real question here about whether that represents a new equilibrium in GP performance, or whether it's really a point in time of exceptional performance. And similarly, with GPs coming back faster and faster, we started to see fundraise cycles compressing right down. But again, is a 2-year fundraising cycle really optimal for our industry? And of course, the ultimate canary in the coal mine to herald the top of a bull market, a massive increase in fundraising for SPACs, and a belief that somehow it'll be different this time. And then, of course, the inevitable pile-on of NFL star and rapper-backed SPAC raises that really start to create even more raised eyebrows. So like anyone who's ever watched Rose and Jack on the bow of the Titanic together, it seemed to us that maybe this was all a bit too good to last. Over the last few years, we seem to have moved from one geopolitical crisis to another. But for the most part, as an asset class, we found ourselves pretty insulated from some of those problems. As we entered the first few months of 2022, though, some of those chickens were finally about to come home to roost. The real reason for that was that we were finally seeing geopolitical and social issues actually translating directly into economic effects. That was most starkly clear when we had the first real stock sell-off since the start of the pandemic in early 2022. But really, it's a combination of a number of very real macroeconomic issues all coming together that will be quite tough to ignore. Firstly, what was already a growing inflation problem has now been compounded by even greater supply chain disruption caused by the Ukraine war. And we're now living through a major inflation spike, actually. which of course is bringing with it a whole cascade of consequences, all the way from baseline consumer confidence, cost of living squeeze, up to higher order business uncertainty around raw material price pass-through and even more complex issues than that. But most pressingly, in order to keep inflation under control, of course, central banks are having to make some really tough decisions between containing price rises and also safeguarding growth and the post-COVID recovery. So just last week, after an initial quarter point hike, the Fed signaled that it's likely to raise the base rate by 0.5 point in May, on top of what it's already done, and that markets should prepare for rates to reach 2.75% by the end of 2022. And beyond that, Goldman Sachs is actually currently predicting a further 5 rate hikes in 2023, with a terminal forecast of up to 3.75% by mid-next year. So in fact, when we look back at the NASDAQ index up at the top here, there's a real risk that the correction we started seeing in January is only the start of the story. There could be a long way still to fall here. We have started to see a few market commentators predicting outright recessions in some markets, but that's still a bit of a fringe belief. On the other hand, the IMF has just warned last week that the world is facing a clear and present danger from high inflation, and that we should expect a serious downgrade in global growth for both 2022 and 2023. So now that we've reached April, we're starting to see the uncertainties of the early part of the year really solidify into a core group of challenges for the whole private markets asset class, which is all driven by the macro we just talked about. At the portfolio level, GPs are having to contend with a real squeeze on labour, from unskilled roles all the way up to the highest paid talent. And they're contending with unprecedented rises in the costs of pretty much everything: food, energy, raw materials, minerals. At the the supply chain disruption that began during the early stages of the pandemic has also now escalated into a really challenging situation in a lot of sectors. So for many years, there's been this truism that being globally diversified was a good thing. It was an improvement, it de-risked. But now there's a risk of a real deglobalization effect, with increased concern around geographic expansion and worries about where the next crisis will come from. This thought of today Russia, tomorrow who knows. And beyond that, the fluctuations that we've seen in capital markets are creating a whole raft of difficulties. From the public market side, the two big issues to contend with are mark-to-market valuations and a slowdown in IPO momentum. So we've already seen a number of high-profile IPO processes put on ice. But then there's the big one, a potential long series of real interest rate hikes causing turmoil in debt capital markets, dampening macroeconomic growth overall, and creating a real change to the fundamental maths of buyouts investing. So now, what does all that mean for private equity, fundraising, and the markets? I'm going to hand over to my colleague, Alexandra Bazarewski, who'll tell you more.
Thank you so much, Gabby. So what are the ramifications for the year ahead? In short, we expect to see 5 key trends over the next year. Number 1, fundraising will be slower for most. While perhaps it won't be tortoise on a beach slow, we do expect fundraising to materially slow from the breakneck pace of the past several years. This dynamic will impact all GPs, save for the most coveted darlings that are by invitation only. Number 2, it will be more of a winner takes more environment. Those coveted GPs will be in a position to take increased wallet share from LPs as it becomes increasingly imperative for LPs to do more with fewer and consolidate their GP relationships. Number 3, there will be no good time to come back to market. We expect a period of fundraising congestion where supply will outstrip demand. Therefore, there will be no good time to come back to market. Each fundraise will have to make a strong case for itself, period. Number 4, as a result of this, LP power will be on the ascendancy. As is typically the case when supply exceeds demand, we expect it to be a buyer's market where GPs will have to consider LP demands more seriously. And finally, we expect to see changing demand patterns. the changing macro environment will impact where LPs focus their time and money. So to kick it off on why we expect life to be slower in the year ahead, we will review the fundamental drivers of fundraising momentum and where we expect to see downward trends. As we all know, fundraising momentum comes from two sides, the GP side and the LP side. From the GP side, fundraising is typically robust when buoyant markets accelerate deal making, when overall performance looks strong, and when GPs are sending a steady stream of exit proceeds back to LPs. From the LP side, the real driver of fundraising momentum is the total addressable market looking to deploy into private equity based on the number of pools allocating, the size of each target allocation, and the capital available to invest. Right now, we're starting to see some warning signs related to these drivers. Starting with the GP-centric side, 2021 was a knockout year for deal making by a wide margin as a result of the pent-up demand from a more cautious 2020. But we expect to see this slow in the year ahead. Anecdotally, we're already seeing this as the investment committee screen gets tighter and as higher interest rates work their way through the supply of credit. With more market volatility, we may also start to see parties having a more difficult time agreeing on price. This, combined with a more challenging IPO environment, is expected to impact the speed of exits, making the realized gains needed for fundraising more elusive. And finally, a more challenging macro environment will put pressure on asset pricing, potentially causing some unrealized gains to flatline. Now, moving over to the LP-centric drivers, I'll start with some good news. The asset class has done really well, and this is bringing fresh new pools of capital online across geographies and investor types. Timing is good for these new entrants, as we expect them to be heavily courted and have lots of options for their capital. In less good news, however, as we all know, no matter how well private equity is doing as an asset class, target allocations are set as a % of overall AUM. While softening performance may address what has become the buzzword of 2021, the numerator effect, softening public markets will bring back the dreaded buzzword denominator effect, as the total AUM pie shrinks and private equity surpasses its target allocation. Additionally, we expect LPs to have less fresh capital in their pocket as GPs are slower to return capital from realized exits, and perhaps as those exits aren't as punchy as once expected. This slowdown could have fairly severe and wide-ranging consequences for GPs. We are already seeing some launches get delayed, the average fundraise take longer, and this in turn is starting to temper ambitions when it comes to fund size increases and platform extensions. As this phenomenon continues, we expect that we could see some high-profile fundraise failures, and this will lead to the next generation of spin-outs and reboots. We also expect that it will provide fertile ground for more GP to GP M&A, as we predicted a year ago in the long read. Turning to trend number 2, we believe LPs may start to evolve their approach to GP relationships. Most LPs seek to build strong, long-term relationships with their GP partners, expecting to participate in subsequent vintages and to support additional platform endeavors. However, over the past several years, this desire has become a lot more expensive. According to McKinsey, compared to 2016, the top 20 fundraising share gainers have, number 1, increased flagship size by 100%, 2, decrease the interval between fundraisers from 60 months to 35 months, and 3, have on average increased the number of products in their suite to 2.3 from 1.7. As you can see in the chart on the right, if you're an average investor that starts with $50 million tickets and you support your GP through this growth journey, the bill over the 10-year period has gotten a lot more expensive. In fact, it's increased by 86%, or $182 million. Now, this increased bill is only half the challenge for LPs and actually doesn't even factor in the additional ways GPs are seeking to partner with their LPs. including GP-led transactions, NAV facilities, warehousing, and possibly even ownership stakes. Now, the other part of the challenge is knowing how to budget in this concept of being supportive of your GP partners over a multi-year period. Thus, in an effort to gain more control, we may start to see LPs radically alter how they communicate their desired allocations to GPs, evolving from something like our primary bite size is typically $50 to $75 million to something more like we are looking to allocate $300 million to you over the next 10 years across your full suite of offerings. Now, as LPs embrace the notion of larger, more multifaceted GP relationships, they will be forced to choose between increasing overall allocations to stick with all their GP partners or consolidating even more around their top relationships. While some will be in the privileged position to choose option one, most will have to choose the latter option. It's important to note that the decision to further consolidate GP relationships is in fact different than what it's been over the recent years, where it was really more about the convenience of managing fewer relationships. This anticipated consolidation will raise the stakes for GPs and create an even stronger winner takes most dynamic.
So for years now, GPs have been accelerating their fundraising to capture what they saw as a strong fundraising environment and allowing them to maintain a rapid deployment pace. Now that outlook has fundamentally changed. And at this point, it's very difficult to predict whether the liquidity situation is going to improve, worsen, or stay the same. And furthermore, it's hard to predict when the competitive picture may ease up. Whereas the right answer to GPs had been to rush back while the going was good, today our advice to them is that there is really no good time. LPs are both resource and budget constrained, so they're delaying commitments where they can, and more than ever looking for reasons to say no. All of that means GPs will need to be ready for a challenging fundraising environment. The bar has gone sky high. GPs need to be prepared for a more forensic level of due diligence and to prove that they bring something truly unique and additive to an LP portfolio. And we are seeing declines starting to emerge, even later stage and sometimes surprise declines at investment committee. So over the years, the last few years, it's really been a GP's world. But the pendulum is starting to swing back now. And it's not just about terms and conditions. We're seeing LPs be much more muscular in setting timeframes for fund commitments and pushing back on what they may see as egregious scaling or deadlines. However, a small group of GPs can still call the shots, the real invitation-only crowd, and we're definitely not forecasting an end to premium terms just yet. But clearly, LPs are making progress on their agendas in a number of directions. On diversity, let's face it, we're now at the point where if you're a GP who is all male, all pale, and all Yale, you're at least starting to be embarrassed about it. And with ESG, it's no longer enough to hire a consultant 4 weeks before the fundraise. GPs are now needing to embed ESG across their whole organization front to back. We've seen a huge increase in ODD requirements over the last few years. You wouldn't believe the level of team resource we commit to turning ODD questionnaires. We're finding that we and our GP clients have to be much more front-footed and prepared in order to investor requirements on this front. And finally, on legal process, one of our clients observed recently that the volume of LP comments they received has doubled with each fund generation over the last 3. And another client, who by the way is a highly in-demand GP, reported feeling that the gloves are off, and LPs are increasingly emboldened to push harder, even on minor legal points, if not the big headline terms.
The final key trend we expect to see in the year ahead is that the changing macro environment will affect buying patterns as LPs seek to insulate themselves from any exposure to private markets beta. In some cases, this has already started happening. We expect that in a tougher market, returns will be more elusive. Therefore, we expect a greater emphasis on specialized teams and capability. This will come at a cost to generalists. Most also recognize that it won't be possible to make money by levering a company and riding multiple expansion. Instead, true EBITDA growth from operational value add will be essential. Furthermore, we have been in an environment where GPs and LPs alike have gotten very comfortable paying up for assets. We think this is changing and that entry prices will come under greater scrutiny. And finally, it's been a long time since we've been in an inflationary environment, but LPs are dusting off the playbook and ensuring that they invest behind assets that will pass through pricing and avoid those assets that cannot. Additionally, after years of focus on having enough tech and growth exposure in the portfolio to keep up with peers in an up and to the right market, the anticipation of a choppy macro environment ahead has many reprioritizing strategies that offer more security, including downside protection and income. History will tell you that in a rising rate environment with inflationary pressure, growth companies feel over 2 times the pain of a 1% increase in rates as value companies do. As such, we expect there to be a renewed focus on a broad range of investment strategies that have been underloved in recent years. This includes an entire spectrum of investments ranging from value-focused buyouts on the equity side to income-oriented credit on the debt side. We expect that this will bolster already positive tailwinds for private credit, where the asset class has grown by 13.5% annually over the past decade, and by all accounts is expected to continue to grow at a rapid clip. We expect that this continued increase in AUM, coupled with dedicated staff and buckets, will usher in a new era of increased sophistication in private credit portfolios, where diversification will be achieved by backing a range of strategies across the risk-adjusted return spectrum. This will create more nuanced portfolios with strategies that have historically fallen between direct lending and equity-like credit returns. Meanwhile, we've witnessed a rather inspiring coming of age in decarbonization and sustainability over the past 2 to 3 years, as LPs are starting to see this as a secular investment opportunity, as they once saw software to be. We see this as happening for 2 key reasons. Number one, the evidence that global humanity needs to make a dramatic shift has become more compelling. It's hot, it's getting hotter, and we all feel that. This is calling the net zero pledge into focus, with 66% of countries and 35% of companies now signed up and more joining daily. Additionally, the Russian sanctions are renewing chatter about the need for energy independence and placing an imperative on doing this with less reliance on fossil fuels. Number two, quite simply, the returns are there. Gone are the days of a concessionary return to deliver impact. Now there is real evidence that it is possible to deliver upon the twin objectives of strong private equity returns and measurable impact. It's important to note that we view this as a microcosm of the larger impact landscape, where, according to HarborVest, 72% of LPs plan to increase their allocations over the next 2 years. That said, while LPs are keen to invest in the impact space, not all funds are created equal, and there's a fair amount of bandwagon jumping occurring at the moment, with 66% more impact GPs in the market today versus 2 years ago. And realistically, that probably doesn't even show the full extent of it. Given this dynamic, LPs have the ability to be choosier and therefore have increased their level of sophistication in assessing where they want to invest their capital. It is our strong view that LPs will only reward the GPs that have, number one, a strong pedigree and ideally a strong track record that demonstrates their investment capability. Number two, a specialized commitment to the space, not someone who's just dropping in because impact is in vogue. Number three, a quantifiable, measured impact that can be tracked over time. And finally, and I'll note that we have it in gray because it's still more theoretical than practical, a construct that links carry to measurable impact. So with that, I'll turn it back to Adam, who will share his advice on what GPs should consider in light of these trends.
Thank you, Alex. So I guess in summary, it's getting harder. The prize for winning has probably never been stronger, and things are also changing. So the question I wanted to touch on here is how should GPs respond in terms of how they build their own strategies and organizations, and also how they should think about fundraising. So starting in terms of the strategy and approach, I think it's probably no surprise to see this here, but it's never been more important to both develop and then articulate a replicable competitive advantage. But as I think we've talked about already during this presentation, the bar for that has really continued to rise. And I guess one piece of advice I would give is that what might have been seen as cutting edge 3 or 4 years ago may not be done so today, and you rest on your laurels at your peril. Secondly, we're clearly in a market where one might say the only certainty is uncertainty, and GPs are going to have to face, and LPs are going to have to face macroeconomic headwinds that we haven't seen for a number of decades in some cases. As a result, people are going to start thinking about risk again and start worrying about what might happen to your strategy and approach in a more challenging environment. And it will be extremely important in that context to be able to make the argument for why your strategy will work both today and in an uncertain future. And finally, in a consolidating world of GP relationships, the fundamentals of any strategy or any fundraising, track record and team need to be bulletproof, and that needs to go beyond just having an explanation for poor performance or for why a key person left. Because the question investors are asking isn't do I understand why that happened? It's should I invest with you versus somebody else? And when they have that choice, the answer to those two questions might not be the same. So if you think of fundraising as a boxing match, which sometimes we do, it's important to be in absolute tip-top condition when you go into that fight, and try not to do what we all do a little bit, which is ignore what the scales are telling you as you're preparing. Moving on to the first point about replicable competitive advantages, I think it's worth sort of talking a little bit about what that means in practice today. I genuinely think an impressive and notable feature of modern private equity is how much better GPs have got at both defining investment strategies with a clear edge and then supporting those strategies with organizational architecture that delivers against this edge on a repeatable basis. And I think that investors are increasingly looking for that in the way that they analyze their GPs. I've provided 3 examples of this on this page, which are examples many people will have seen in many instances. Starting with sectors, people increasingly don't talk about sectors anymore and go beyond sectors, whether it be talking about clusters, microsectors, niche thematics. One of our GPs, who I'd say is a leading sector-based GP, said proudly at their AGM recently that sector specialists are the new generalists. You need to go beyond that if you want to develop an edge. And GPs across the board are going to what I think consultants call the bottom of the T in terms of understanding, in terms of developing networks to deliver replicable investment opportunities. In terms of investment style, we see GPs increasingly and often combined with a specialization sectorally, focusing on a particular type of value creation strategy. We've got some old favorites on this page, the carve out, the roll up, but you also see newer things such as digital transition, as that thematic continues to be important both to digital businesses and to more traditional businesses. Importantly, rather than just saying you're doing this, what you're also seeing is the development of specific and replicable playbooks that can be diligenced behind those core strategies. And I think the continual refinement of that is an example of this increased specialization. And then finally, on the value creation side, we're seeing the continuing march of increased internal sophistication with GPs increasingly insourcing elements of the value creation journey that they would previously have outsourced either to management or to service providers. And again, to kind of loop back, underneath all of these initiatives, I think there has been a meaningful investment in the size and structure of how GP teams are organized in order to deliver against it. And I think, when thinking about your organization, you should be thinking about how the way, it's not only what you do, but it's how you set yourself up to deliver against that, which is going to get analyzed when people come to think about who they're investing with for the next 10 years. Going beyond the kind of core process of value creation and taking a slightly different tack, we're seeing innovation in the deal craft of private equity, how deals are bought and sold. This includes, and how returns are generated. This includes asset management, how companies are bought and sold, but also fund management, how net returns are delivered to investors at the fund level. And these days you get assessed very much on both. Now, of course, this is terrifying oversimplification because it has the terms 0.0 on it. So appreciate the world has not quite evolved this clearly. But we wanted to make the point that what we are seeing with this kind of evolution is a welding together of what were historically distinct parts of the way GPs thought about their lives, the deal side and the return side and the LP side. And you can see that across deal making, exiting, and the way that they manage their portfolios and funds. When buying a company, many LPs are increasingly seeking more than just syndicated co-invest and maybe looking to come alongside their GPs when they're doing transactions. And in some cases, dare I say, they are particularly valuable partners in doing so, particularly when compared to teaming up with a rival. When selling a company, that same investor might be the person that you decide to sell the company to. Or it may be, you may want to consider selling to a consortium of investors in a vehicle that you continue to manage. And these are different routes to exit that GPs didn't think about in the past and that are now becoming part of the armory. But then finally, in the end of the day, LPs get the net returns, not the gross returns. And so the way that you deliver those back to investors is important. And this could involve an evolution in the way that you think about leverage. For example, in the past, you would think about leverage at a company level. Today, maybe it makes more sense to think of it as a fund level to optimize net IRR delivery if that reduces financing costs and reduces risk. And then finally, moving on to the fundraising strategy. You clearly, everything I said on the previous page talks about how the investors have become central, not only to the provision of capital for funds, but also for deals. And I think the core message here is that the investors today more than ever, your existing investors are the sort of core of any fundraising strategy. Raising new money is increasingly challenging, and so the fight is first and foremost to make sure that you get your existings back. How do you do that? Well, a variety of ways, none of which are probably particularly new. Firstly, real relationship development. So we've been in an unusual period, and it's been difficult to engage with investors on a personal basis. That has clearly changed, and we're pleased to see that many of our GPs are now getting back out on the road and meeting with their investors. And ultimately, in a business like this, there is no substitute for face-to-face relationship development. Secondly, you see there were tools that were developed through COVID, digital tools that are quite popular. Things like this event is a digital event, and this is a way that you can stay close to your investors beyond having to go and see them directly. And some of these things should maintain as we move forward into the new world. And then finally, as we've talked about in this presentation, LPs are increasingly looking for multi-transactional relationships across a whole variety of different areas, and clearly optimizing the provision of those is important. Beyond that, we are in the business of raising new money. And as I said, we're in a more complicated market for that than we have been in the past. And so I think in some ways, the answer there is, in addition to the usual channels, you may need to get creative. That could include going to geographies that are possibly less saturated in terms of capital coming back to market, and where the programs are at an earlier phase of their development than has been the case in the US and in Europe. It's no accident that Rede opened up in Asia, a variety of reasons, but one of those was because we felt that it would be important to be part of the continued development we're seeing on the LP side in that market. Secondly, a lot has been made of the democratization of access to private markets, and the high net worths generally remain pretty underpenetrated in private equity, and many innovative platforms are looking to capture that trend, and that can become an important plank of your fundraising strategy. And the final point I'll touch on here is that that we'd all support is if you do know any good lobbyists, it's worth noting that half of global pension fund assets are in DC defined contribution assets, or 401ks in the US, and they have no exposure to private equity, and they are the part of the pension community that is growing. So an increasing lobbying effort to provide access to that for that group, for all of our benefits of private markets, is not a bad strategy today.
Just to recap, it's been a wild ride. We've benefited from a whole range of tailwinds that have created an unprecedented boom in private markets. But by late 2021, we were starting to see evidence of real top of the market behavior. And with the macro tides now starting to turn against us, we need to prepare for a potential correction, and that there might be some real pockets of underperformance within the sector. But on the bright side, challenging times inevitably throw up valuable opportunities. And more fundamentally, the very mechanics of how private investment works brings with it a number of advantages that are valuable in and of themselves. Firstly, the don't panic nature of long-term capital really comes into its own in tough situations to help us sail through short-term squalls. And when the going gets tough for individual assets, private investors have the agency to seize control of the steering wheel, both operationally and, if necessary, by injecting further liquidity into struggling businesses, often using capital from investment vehicles that they already control, which of course helps ensure they can do that on very favourable terms. Importantly, it's also private markets investment mandates are also flexible enough to adapt and course correct as market cycles evolve. And in fact, what we've seen over time is that on average, private investors have been biased towards selecting the best performing segments in each market cycle. It's no accident, for example, that coming into COVID, private equity was much more exposed to healthcare and software and much less exposed to some of the hardest hit sectors than the public markets. GPs were already carefully preparing for a downturn of some sort, and they'd identified those sectors as offering excellent opportunities for risk-protected growth. So when you take all those advantages and you put them together with the entrepreneurism that's typical of private markets investors in general, and the way in which fundraising is essentially a regular referendum on whether a GP should survive or die, and we end up with a rather brutal but very efficient Darwinian system that's primed to adapt and evolve in the face of whatever the markets throw at us. So if right now we're at step 3 along this evolution, I think that's the guy with the jeans and the leather laptop bag you can see in the middle there. We reckon that by the end of 2022, even if it's been tough at times, all of you will have at least grown a nice bionic arm to help you ride it out.
Thanks, Gabby. So this has been our attempt to distill some of the trends we're seeing in this market and to stick our necks out and make some predictions. We do think we're in a unique position to offer this perspective, being in the flow between LPs and GPs. Now we'd like to open it up to some questions you've been sending in during our presentation. Thank you. I can see some good ones coming here, and it's not too late if you want to send more. I will start with one. What does all of this mean for first-time funds? Adam, do you want to have a go at that one?
Thanks, Scott. Well, look, raising a first-time fund is never easy. And obviously, some of the challenges we're talking about will not make it easier. And I guess what we are also seeing is there being a competitor to the traditional independent first-time fund, which is the platform extension. So those are all things that one needs to consider. But again, I don't think it's ever been easy to raise first-time funds. On the flip side of that, I think there's probably two relevant points it's sort of rays of light. One is that we are seeing it's not a huge world, but it is a growing world of the seeding industry, people who are looking to put GPs into business, and as a consequence of that, receive some of the carrots we've talked about in this presentation, whether that be co-investment, whether that be a share of carry, those sorts of things. So that is developing into somewhat more of an industry. And I think the second thing is that, as Gabby alluded to, this is an entrepreneurial business, and whether it be for great performance or for not so great performance, actually, talent does get released sometimes from organisations, and there is a long history of investors knowing that talent is at its most motivated when it sets up new firms and gets going. And so I think that will continue to be an important part of the industry. And at Rede, we're proud that we've worked with a number of first-time funds that have gone on to be very successful, and we will continue to do so because we think that constant refreshment of the talent in this industry and the approaches people take in this industry is key for continuing to keep private equity on the cutting edge of return generation.
Thanks, Adam. Just a reminder for everybody, if you have a question, please do type it into the Q&A box on your Zoom. Here's another one. I think I'll direct this to you, Alex. Are you seeing geographical or other differences between LP allocation and capacity constraints?
Good question. So I guess this really, and sort of Adam talked about this a little bit, but it really does come down to sort of an LP, the maturity of an LP's portfolio and their exposure to re-ups. Therefore, sort of realistically, we're seeing some US public pensions have less capital available than, say, some of the newer programs that you're seeing that have come online in Asia over the past several years. So, it's no accident that we've opened an office in Asia. We think that's a really important and growing market. I'd say that actually beyond geography, there are some other sort of pockets of growth. Most notably, I'd call out a lot of the health systems that we're seeing come online here in the US. And then also, and again, a theme we've talked about a lot, but just the growth in wealth channels, OCIOs, and sort of that category of investor.
That's great. Thanks, Alex. Here's another one. And Gabby, I think I'll direct it to you. With all this congestion in the market, it seems that the process is very inefficient. What can everybody do to make processes more efficient?
I can see why you've directed that one at me. That's definitely a matter close to my own heart. So, obviously our role as advisors is to help as much as possible make this process really efficient for our GP clients and for our LP friends. And we've put a lot of effort into smoothing that process over, but we do believe that there's a lot further to run on that. And actually, if you think about it, one thing that sort of sometimes makes me laugh a bit about our industry is it's run by people who are sort of obscenely intelligent and extremely well educated, but most of them started their careers in investment banking and essentially were trained only in Microsoft Excel and PowerPoint. And so, in the same way as to a carpenter, every nail, every problem looks like it should be solved with a hammer. To a private equity fund manager, often it seems like every problem should be solved with another PowerPoint deck and an Excel tracker. I think that we really need to bring technology and and IT in general much more into the fundraising process. But beyond that, actually, we can do a lot more with video, with webinars like we're doing today, making sure that the DD process, if we are having people that want to meet with lots of portfolio managers and CEOs. That should be something where we create banks of videos that can be, that can be watched at leisure, that, we can have questions sent in so it becomes a webinar rather than everybody meeting at the same time. So that's kind of some of the easy wins. But beyond that, we think there's really a lot of room to run. So, for example, when we have subscription documents coming in for some of our, multi-billion-dollar funds that we're raising, there's just huge amounts of emails and Word documents and PDFs and Excel trackers, and that's something that we think is just totally ripe for, tokenization, for example, using blockchain technology, so that you have a protected technological register of subscriptions, and that everybody's able to see that, and you can see also as liquidity creeps in. So we think that there's so much more to do on that, and we're looking forward. Please watch this space, because we have a number of exciting technological developments we're looking to launch over the next year.
Thanks, Gabby. Some of us were trained even before PowerPoint and Excel. I started on Lotus Notes, just so you know. Maybe we have a time for one more. And this just came in. Alex, maybe you and I can handle it, but are you seeing travel and in-person DD coming back? And I'll kick off, but please add. Definitely. I mean, if the first quarter theme was, from the LP side, was we're deluged with re-ups, please leave me alone. Suddenly, we're in AGM season, and I got a couple messages this morning that I'm trying to reach an LP who's at an AGM or traveling for their AGM. I do think, to a point Adam made earlier in the presentation, people are thinking about ways to make digital or virtual engagement productive. So we'll see travel open up increasingly, and we're seeing more roadshows. We're doing roadshows here in the US for some of our European clients and vice versa. But I do think and sense that LPs will be trying to be more efficient and more productive, to Gabby's recent comment, by using virtual, certainly for initial meetings more often. So the whole process of planning a roadshow becomes less about, hey, we're in town, but how can we use an allocation of GP time most efficiently and keep it productive for both the LP and the GP? I don't know if you'd add anything, Alex.
No, Scott, I think you really did sum it up well. And I think, this dynamic just puts greater emphasis on, having real sort of deliberate content in virtual settings. And then, maybe thinking even more about how do you bring out the relationship element when you're seeing in person, and really make sure that not just sort of the founder and the LP are connecting, but even beyond that, the greater team is really connecting with members of the LP.
Great. Well, it's the top of the hour, and so I think at this point we'll thank you all for your attendance and participation. We hope this has been productive for all of you, and look forward to seeing you next year.